It's interesting. If you look at the past couple of years, what has been driving it? It's been how much leverage, you know, the lenders would let us put on the business. And that's basically been the methodology that, you know, private equity has been under the guise of, you know, staple financing. You see 8 times staple financing packages put here, so you're sitting there and go, okay, we'll buy it for 10 times, 12 times, and go at it. You know, where we sit at Shamrock, we're not, you know, taking advantage of the leverage markets the way that others have been. You know, knock on wood, our portfolio has been reflective of that. You know, in some cases, you know, where lenders would say, hey, you know, take 6 times, we'll say, no, we'd rather have taken 4 times, and what can you do on the pricing? And that's kind of bode well for us on how we have done things. What you're seeing currently in the market is that lenders are completely more restrictive of what they're wanting to do. We're going out and having to talk to 4 or 5 lenders on a specific investment rather than 1 or 2. And those 4 or 5 are asking a lot more questions, and we're spending more time getting them up to speed on the business, because at the end of the day, you don't know if they're going to be there. You don't know what questions they might ask in the last second and what their investment committee may be, telling them that they want covenants or pricing. And so we're really going out there and spending more time. So what does that do to your multiple purchase price multiples for acquisitions? Well, it's brought it down. You know, it hasn't always been, we've never been those guys looking for the auction properties and bidding things up. And, only one of our companies, our portfolio, went through an auction process. And so we haven't really been having to deal with that on a day-to-day basis, but our peers have, and I think that's what's been reflective of the market, is that they've overpaid for things because of what the leverage allowed you to do. Today's market, things are different. You're probably seeing multiples more in line with what you saw 10, 15 years ago. And you know, you're seeing equity guys having to roll their sleeves a lot more to make a return on their invested capital.
Coming from the debt side and financing most of the PE stuff, I'd absolutely agree. And again, it's important to note that in the past decade or so, purchase prices were really dictated by how much money you could borrow. It wasn't based on fundamentals that you learned in your MBA program or market multiples, because frankly, market multiples would change.
Yep.
You know, if you looked at market multiples for the last decade, they're trending up as credit became looser and looser. And in the last 12, 18 months, there's been a very quick about face, and people are actually thinking about, hey, maybe I should be looking at this type of stuff, spending more time in the analysis. We're actually doing the work now that we should have been doing for the last 15 years. But, hey, everybody was at the party, it was go-go times, and, an incoming tide, all boats rise, and everybody was enjoying the view.
I think what you're spending less time doing is looking at historical transactional.
Absolutely.
I mean, you are not, when people put that as kind of, okay, well, these things, here's the past 5 years, here's been the mean of where these things have traded in hands, and that's not being done anymore. That's not a basis for your analysis. It's one of the variables, because but it should not be the one, or it's not the one that's dictating the answer at the end of the day. You're really putting, a formulaic response, looking at DCF, you're looking at everything. And then you're trying to figure out, what can you do with the business? From an equity standpoint, what changes, what value add can we bring to the property so that we can see what the returns potential for us are? We're not as focused on IRR. I mean, it's a great measurement. We're really focused on cash on cash. What cash on cash returns? What can we do? Because the time horizon has shifted. Whether shorter or faster depends on the company, depends on the sector, depends on many different variables. But you're really spending more time in your analysis and not just basing yourself on historical trends.
I think as a response, when people classify acquisitions, they're usually probably talking about change of control transactions. And I think what's probably characterized the last 12 months is that whoever is in the market has a reason to be there. It's the question that it's looking at businesses, you always have to ask first, why are you selling? And a lot of the properties that are out there that we're not participating in auctions, but our peers are looking at companies that really have they're worried about their ability to refinance their existing debt. It's a portfolio company of a private equity fund that is been held for longer than the standard hold period. So as we see it, I think the people that are out in the marketplace today are people that really have a reason to sell that hasn't been traditionally a very good reason. And so the buyers that you're seeing are generally opportunistic. It is an opportunity for a privately held business to acquire a competitor that they never thought they have the opportunity to, and the thought that there's more the ability to have oars rowing in the same direction to weather the current storm and hopefully get to an environment where lending comes back and you can get that multiple that was maybe not 2 to 3 years ago, but was 4 to 5 years ago. So I think that's the current acquisition environment. And I also think that strategic acquirers in this market definitely have an advantage because of not looking at necessarily what the multiple is. Their framework a lot of times can be, is a transaction accretive or dilutive, and they have cash. And so a lot of properties that are in the market, they're winning.
Final comment on the debt side. It's very interesting. You mentioned, what's your exit strategy, who's going to buy this company, et cetera. When you're making leveraged debt investments, it was just a handful of years ago, the average life of a loan was, Alphonse, would you say 18 months? You'd underwrite a transaction, the company might have been bought at a higher multiple. The credit facility that was put in place was refinanced with a lower coupon. But the analysis we're doing on the debt side, you don't even look at how you're getting your money back. You're worried about how you're going to keep this asset on. Because frankly, it's going to be gone in a year and a half. You don't have to worry about how they're going to pay their money back. Somebody else is going to refinance this thing. Today, we're looking at transactions, you're looking at this company, how am I going to get my money back? Because frankly, in the past, there's so much damn debt on these things, that they don't have to generate enough cash to pay it back. So you've got to look at the enterprise value of these companies. Who would be interested in buying this company? Can I break up this company? Where is the value? And then you go deeper, looking in a down market. What parts of this company are susceptible to the downturn? If I have to break it up, what happens if I have to foreclose and own this company? That's reality today. Where 3 years ago, geez, it was really, how do I keep this loan on the books and keep my fingers crossed that it doesn't get refinanced at a cheaper rate?